What up, though, YouTubers? It's your boy Trey from DigitalDollarsTrading.com, and I'm excited to drop some gems on y'all today. I got something for your ass, I promise. What if I told you I could show you how to know when to perfectly time the market? And what I mean by time the market, knowing exactly when to enter the market, and most importantly, when to exit and get out with maximum profits. I got all that coming for you, I promise. And when you peep how that flow come in, I guarantee you jump back on my dick. But check it out. Before we get started, y'all already know what I need you to do. I need you to like and subscribe to my channel. Show the algorithm that you rocking with your boy, and check out my website, www.digitaldollarstrading.com, if you want to have a mentor that can show you how to options trade and crypto. I promise you nobody does it better than me. But let's go on and get started with our topic for the day: how to know when to perfectly time your entries and your exits in the market. So what if I told you that there was a correlation between presidential approval ratings and stock market performance? You would probably be like, huh? Or you would probably be like, oh yeah, that makes sense. Like if the president's approval rating is high, then the economy must be doing good and the market would soar probably to all-time highs, right? That's what you'd be thinking. Or if the president approval rating was terrible, the market wouldn't be doing great. That's probably what you would be thinking. I already know that's what you would be thinking, actually. But the truth is that stock markets perform the best when the presidential approval rating is middle of the road, like right under 50% approval rating, somewhere between 46 and 48% is when the market performs the best. And I'm going to tell you why. So Pete, if the presidential approval rating is too high, and what I mean by too high is like 60% or above, the market only grows at a rate of about 2% on average. And you're probably wondering why. It's because things feel too good. And when things feel too good, the market doesn't like that because they feel like the president has extra leeway to make major policy changes. Like maybe he's going to increase taxes by a lot, or maybe there's going to be some type of huge policy shift. And think of it like the fear and greed index, right? When markets are in a state of euphoria, that's when it's time to sell. It's the same thing with presidential approval ratings. If the ratings are too high, that means things are too good. The market doesn't like when things feel too good because they feel like a major change can come. And the exact same thing goes for when a presidential approval rating is too low. The approval rating is too low. That typically means that the president is dealing with an economic crisis, instability. It can also mean that like inflation is really high. So the market doesn't like that because they're thinking like there's job losses. So the market's not in a really good state for growth. So when the presidential approval rating is really low, markets don't grow either. They perform terribly. But when you find that middle of the road presidential approval, like 47, 48%, markets boom. They tend to go crazy. They tend to reach all-time highs because it's a balanced environment, which means the president's not so weak that he can cause a political crisis, but he's also not so strong that he can make drastic policy changes. So everything is just balanced. The market likes for things to be balanced. So when there's a balanced approval rating, you're going to see the markets perform spectacularly. Typically, when a presidential approval rating is right below 50%, that means that the Congress is split. The market likes when Congress can't pass laws too easily. The market loves when the presidency and the state of Congress is in a gridlock. The reason markets love this is because there's less regulation, less tax hikes, less chance for radical policy shifts. So again, that balance, the market loves that because there's no sudden fear of any type of shocking change that's going to come out of nowhere. Markets thrive on confidence. So when an approval rating is very, very low, that means, once again, that we're dealing with some type of crisis. Business sentiment is way down. So investor confidence is down. Nobody wants to invest in a market when everybody is scared, when the markets are scared. So the markets love a moderate approval, because that means that the economy's functioning well and it's not facing any major upheaval. I cannot stress that enough. And all you really got to do is go back and look. In the Clinton era, Bill Clinton, his entire presidency, he had a moderate approval rating. And what happened? Markets boomed. I don't know your age, but I can remember it seemed like everybody was rich during the Clinton era, right? And when Obama first came on, Obama's approval ratings were very high. And guess what? The market didn't do shit. The market was not great. It was very, very steady to no growth until the middle of his term. His approval rating, it kind of fell off, and then the market started to surge under Obama. And if you look at Donald Trump's last presidency rate, his last presidential campaign when he was in office, what happened? Markets hit all-time highs because his approval was in that moderate range the entire time. So what's going on right now? Well, Donald Trump's approval rating is right now, it's a 47%. And what's happening in the market? We're right back near all-time highs. We hit all-time high last week, but when he started talking about the tariffs, the markets took a dump because the markets don't like that uncertainty. But once we made that deal with China and Canada, guess what? The market started to climb again, and we're right back to all-time highs. And let me give you an example of a presidency with very, very low approval rating, and that was under Richard Nixon, okay? Nixon's approval rating was in the mid-30s, and markets did absolutely terrible. So what I want you to take out of this, especially if you're investing for the long term, the key thing to watch when your money is in the market is the presidential approval rating. As long as approval rating is middle of the road, keep your money in the market. If people start liking Trump too much, I don't know if this could happen because he's a pretty radical guy in my opinion, but if you start seeing Trump's approval rating climb over 50 and get into the mid 50s and upper 50s, it might be a great idea to start shaving off some profits because we're getting closer to that presidential euphoria and things are looking too good. And obviously, if that approval rating gets well below 40, that's another time where you probably want to chill, or you can leave your money if if you have a long-term mindset, but expect for markets to be stagnant for some time, when that happens. And if you're not in the market yet, just hold on to your money right now. Hold on to it. Wait for that presidential approval to dip down under the 40s, and then it might be time to start metering in. That's called dip buying. Long-term dip buying. So now you know one of the hidden gems that you need to look at to know when to get into the market. I'm curious to know your thoughts, so make sure you share them with me. I hope you found this video informative. Try to give you outside the box ways of thinking about money and investing. I want all of you all to get filthy rich, man. Fuck with your boy, like this, share it. More importantly, rock with me long term. You see the website scrolling at the bottom of this screen. You can join my Discord where we got hundreds of members that are learning, that are eating. We do crypto, we do options trading, we do futures trading, we do long-term trading. I got AI bots in there if that's your thing. We all trying to win. So rock with your boy, man. and I'm out.